Guys, when it comes to trading, I've been around the block. I learned in 2012, so 13 years ago, from an ex-CME Goldman Sachs trader. And I've spoken at global events all around the world. And what I want to do in this video is show you guys just how simple trading can be. This exact strategy makes me a full-time living and has done for many years. Everything that you guys have been through in trading, I've probably been through it. I built my edge, I've lost my edge. I've spent tens of thousands on mentors, courses. I've used every indicator you could ever imagine. I've tried every single strategy there is out there. And what I always came back to was simplicity, a simple strategy based on higher time frame levels. Something I learned back in that first year of trading with my original mentor. Let's hop on the charts and get to it.
Okay guys, so I realized that I was overcomplicating my trading the whole time. And all I needed to do was to trade a simple supply and demand strategy that I'd been taught at the start. But I'd obviously ignored that and I'd gone down the path of complexity. I thought that I needed 1,000,001 other indicators. My charts were really cluttered with loads of drawings, technical trend lines, fibs, EMAs. I was looking at multiple indicators on my chart at the same time. Now my chart is very clean, it's very basic. All I'm looking for is supply and demand zones. Now this is literally a trade we took last week. It was Aussie dollar, US dollar short. We took a sell order just up at this area of supply. And I'm going to show you guys exactly how we identify these areas. So what we're looking for is we're looking for a candle that has a smaller body than wick. So that indicates indecision. This candle here has large wick, it has a small body. So it's more wick than body. Same with this one here. Same with this one here. Doesn't matter if the candle's bullish, bearish, if the body's in the middle, the top, the bottom, wherever, as long as there is a bigger wick or larger wick than body on the candle. Now this candlestick here would not be an area of supply or demand because it has more body than wick. So really simple. That's what you're looking for. A couple of examples of this would be this. So here, this is what we would call a rally base drop. So the price has rallied. So these candles here, bigger body than wick, sorry. Then this one here, smaller body, bigger wick. Indecision, then the market's moved away. Now that's another element within the edge that we're looking for. We're always looking for price to be moving away from the zone aggressively, whether it's to the upside or the downside, because that indicates a stronger influx of sellers here. The buyers were in control, they pushed price up, there was indecision, accumulation of orders, and then price was pushed down again aggressively. That shows that the influx of sellers outweighed the buyers and they took control of the market. And that's how we'd mark the zone off. So we would mark the zone off from the body to the wick. Bottom of the body, top of the wick. If we really want to refine it, then we could go to the lower time frame and we could find a supply or demand zone within that supply or demand zone. So say this is on the daily time frame, we could then go to the 4-hour and refine the zone. But being aware of that overall higher time frame zone is really important, right? So next, this one would be a drop base rally. So it's the inverse. It's the opposite of what we just looked at. 2 candles with no wick. Then we get a candle with more wick than body, indecision. Then we get a strong move away. 2 candles with more body than wick again. Debatable here, but that's not the sort of candle that we're looking for. We're looking for a clear candle that definitely shows there is more wick than body. And again, we'd mark it off. Top of the body, bottom of the wick. That's the area of demand in this case. We could refine it again. We could look within this wick to find the lower time frame demand, but being aware of the overall picture again, super important. Now here's a slightly different example. This is what we would call a rally base rally. So price has moved up, it's rallied. The sellers tried to take control, but the buyers outweighed them and they pushed price higher again. So rally base rally. That just shows an influx of buy orders taking control over the sell orders. So again, that is another area of demand in this case, because price is above it. If it comes back into this area, it's an area of demand. Demand we buy, supply we sell. And this is the last one, which is a drop base drop. So it's just the inverse of what we just saw there. Same thing again, aggressive sell. Some buyers tried to take control, they couldn't. The sellers pushed this all the way back down and then drove away aggressively again. So good influx of sell orders taking control of the market when the buyers stepped in once again. And we'd mark it off this way. That is a drop base drop, and that would be an area of supply because price is below, and when we expect it to come back in, we expect it to react and sell off. So you'll find these all over the charts, all over the markets. This is Euro US dollar. This is just recent price action that I just pulled up. I just marked some off here. Yep, there's loads all over the place here, but I've marked some off so you can see them. Here you can see there was an area of this green candle here, more wick than body, more wick than body, more wick than body. Price traded back in, reacted. There was one here, more wick than body. This would be a rally base drop. Price came back in here, then it also came back in here, reacted again. I'll just go back to that. There was another one here, which was rally base drop, same thing. Price came back in here, reacted. There's one here, which was kind of indecision. You might be able to look at that on the higher time frame, which we can do in a second, and we'll see that there was a clear area of demand here. But again, you can see price traded back in, rallied away. There's loads of examples of these working, but there are also examples of these failing. And I'll go through why some of them fail, why some of them work. And essentially, if you find an edge, if you find a strategy, whether it's based on support or resistance, fair value gaps, liquidity sweeps, trend lines, whatever, if it's got a win rate over 50%, then it's profitable by default. If it's got a win rate around or under 50%, but the average of what you make when you win is a lot more than when you lose, then again, it's an edge. And that's all we're looking for. We're just looking for something in the markets that occurs more often than it doesn't, or when it does occur, it wins more often than it doesn't. Okay, so looking at the chart and looking at that AUD USD that we showed at the beginning of this video, or that I showed you guys at the beginning, it was just a simple area here of supply. Price traded back into that zone. Now, you can see when we got into that zone, there was a really strong reaction. So let's go right down to the lower time frames, and we can have a look at what price did when it got up there. I'll take this off so you guys can see it clearly. If you have your own model, if you have your own entry criteria, say on the 1 minute, the 5 minute, the 15 minute, whatever it might be, this is where you can use it. It's all about context. I just simply sold this level. The reason I sold this level is you can find my free resources. I teach market alignment. I had reason to believe that the whole market was about to turn, and it did. The whole market turned. All of the US dollar pairs, stocks, yields, everything turned at the same time. Now, if you guys trade fair value gaps, then this is where you could look at your fair value gaps. If you trade inverse fair value gaps, this is where you could look at a break of an inverse fair value gap, whatever. It's all about context. The reason those strategies fail a lot of the time for certain people, is because they have no context. They're just taking inverse fair value gaps. The first one presented at the New York Open on NQ, for example. It's not really an edge. There's no reason why the market is going to turn there just because you have a fair value gap. It's all about finding those bits of analysis within context, within the larger, the higher time frame areas. And you guys can see, the move to the downside here is huge. If we actually go to the 4 hour and I come off the replay tool, this is the high of the month so far. We're in September. We're now coming towards the end of September. That's the high of the month to the pip that we sold. And we commonly do that. I commonly sell or buy the high or low of the month because, one, I'm utilizing cross-market alignment. So I'm using the whole market. Where do I think it will turn? I'm using supply and demand, which works. It works. And I'm taking the trades as limit orders, essentially. When price taps in, I'm not waiting for that lower time frame confirmation necessarily. So really, really simple. All I'm looking for on these trades most commonly is at least a 1 to 2. I will scale out some of the position. I will leave some to run. When we drove into this level, it was actually a Powell speech. Powell was about to talk. The Fed rates decision had just come out. There is no coincidence that we traded straight into an area of supply. We had multiple other pairs doing the same thing and other assets, and the whole market turned on that news. And that is where we find these big trades. Now, they don't come about every single day. They do, however, happen most weeks in the market. There is usually 1 or 2 of these every single week. And my goal as a trader is not to sit and stare at this chart all day, every day. If I wanted to do that, I'd go and get a job. I want to trade as part of my lifestyle. I want to be able to pre-identify these in the morning. Then I want to be able to get on with my day, enjoy my life, wait for my alerts to go off and act accordingly, right? So in subdued market conditions, when markets are very sideways, when there's not very much action, when there's not very much going on, you will find that these levels play out more often than not. When we get a heavy trending market, for example, heavy sell-off here, then you're going to find that these levels are less likely to play, because there is something bigger happening. There is not a big sell-off happening on Aussie dollar. There's not necessarily a big buy happening on US dollar at this point. This could be all to do with the bond market. This could be all to do with the S&P 500. Are people pulling out of their pensions, their 401ks? Is that then directly moving this market or indirectly moving it? So your analysis is all relevant to market conditions and what's moving the market at the time. Now, this model itself has over a 70% win rate. There has been a point in time through a quarter where I've traded this at an 88% win rate. There have been other times where I've traded it at 69% through Q1 of 2025. So it varies, but it's always been profitable for me ever since the day I learnt it. And if you're finding this strategy a little bit complex or a little bit difficult, then there is a link in the description where you can work with me personally. I do coach traders individually to learn this edge, to build data, to build a profitable system, and essentially become profitable prop firm funded traders if that's what they wish to become. And I'm going to give you guys actually something completely free here. So my market alignment checklist. Now, I've talked a bit about alignment in this video, how things lined up for this particular trade. If you guys use that checklist, you join my free Discord server, you'll also have access to loads more material. I've said previously, I've been doing this since 2012. So I know a few things, and I can fast track your learning so you don't spend that 4 or 5 years that I spent testing every single indicator, staying up all night. There are periods where I've stayed up for 16 hours, 20 hours plus, testing, constantly becoming obsessed with the markets, trying to find what works, what doesn't. The reality is that's not necessary. What is necessary is finding a basic edge, use mine, and then refining it through data. Do that with me. It's really simple, guys.